Good morning, everyone. I want a response to know whether we are communicating. Can you hear me?
Yes, I can hear you, Mwalimu.
Wonderful. Now, today I want us to look at the accounts for banks. And I've shared my screen. And you might have covered this in your financial institutions and markets. So I'll want to summarize the literature part of it. I don't want to delve much into the literature. But basically, the banks are regulated by the Banking Act, which is Cap 488 of the laws of Kenya. So you can have a look at it if you want to go deeper and understand. But basically, in the A to Z of licensing a commercial bank or a mortgage finance or an unbanked financial institution, the stakes are too high. You have to be regulated or to be accepted by the central bank or Central Bank of Kenya, in our case, for you to be allowed to use either the word bank or finance in your business name. So I think this is one of the limited companies that you have to be cleared by the regulator before you go ahead to the register of companies for incorporation. And we know the reason why the stakes are too high, because of the loopholes that we've had in this country, different countries and territories. We know that there is a lot of money laundering. It is one of the emerging issues in the financial space. And we know that we have a lot of terrorism financing, drug barons, what we call smurfing. And smurfing, these are criminal activities of basically making the illegal money into legal money. And the easiest loophole of making illegal money to be legal money is by injecting it into the economy through a financial institution. And that is why the stakes are so high. So central bank will receive your request to use the name bank or to use the name finance. It is only in Kenya that you'll find people using there's a difference between an incorporated company and business names. So you'll find someone with an ATM, a milk ATM, and they are calling themselves a milk bank. Well, that is allowed in the street. What you cannot do, or what I'm saying is, you cannot register any limited company. Some people may say even we use things like power bank. That's just a word to try and define a gadget. I'm saying any limited company that need to be incorporated by the registrar of company in Kenya, and they require to use either the word bank or finance. You have to be allowed by central bank to use that, and that is at the preliminary stage. So you have to go to central bank, of course, licensing department. They'll have a preliminary meeting with you, and they'll try to understand why do you want to open a bank. Then from there, of course, if accepted, assuming everything goes well, they will allow you to go ahead and apply to the registrar of company for incorporation. Of course, they'll give you a cover letter for the approval. So upon incorporation, that is not the end. they'll have to come and audit. They will audit the structure or how you want your bank to be structured, and this is the organogram. They'll want to understand who heads the bank, who are the directors, yeah, both the executive and non-executive directors. They will want to know the owners of equity. And this is where now the matter is. And this person, they have to be scrutinized because they'll try to understand why they want to run a bank. You realize that in Kenya, it is almost given that you cannot run a bank as an individual. So most banks that we have started either as MFIs, the microfinance institutions, and then after attaining the capital or the core capital that is required by CBK, they go ahead and now apply for a banking license. It's easier that way than going as an individual. Reason being, even if you are an individual and you have that cash, the details of the sources of capital have to be scrutinized, and you cannot own a bank at more than 5%. So the only core capital that the permanent shareholders or the promoters of a given bank can hold is only 5%. And there is a reason. There is a reason. If you own a bank, you become very powerful. And you can even end up even turning against the government. So there is that fear, and that's why the stakes are so high. We'll also realize that you cannot, even if you are the owner of that bank, it is not allowed to advance any person or any institution and advance or credit or guarantee. This authority is only held by the Central Bank of Kenya, not any other person. So you know that Central Bank of Kenya is the banker of all commercial banks, and they are the regulators. So you can go through the CAF 488, the Banking Act, to understand more on the provisions. Of course, you have the accounting or the requirement if you needed to open a bank. And these are basics. When I talk of at least 1 billion, now depending on tier, we have 3 tiers. We have tier 1 bank, we have tier 2 and tier 3. Depending on the category of the bank that you want to, the entry, what do you want to be? Tier 1, tier 2, or tier 3? Some may start as an MFI, go ahead and register a bank, and then that growth, if the growth is exponential, they may gradually leave one tier and go to the next tier until they go to tier 1. So this is the basic. You need at least 1 billion paid up and unimpaired reserved. By impaired, I mean the other amounts that you're providing is supposed to protect the customer's deposit. Again, most of the banks in Kenya, the ones that have gone under, and we have 3 since 2015, who've been put under receivership by Central Bank, and the owners of the deposits were at the verge of losing their cash. So that's why the stakes are so high. So before you are even liquidated, you must have provided for, or you must have cushioned the deposits of the customers. And we are saying that 7.5% of the total deposit liabilities. You know the bank is in the allow me to pick this one. Am I back? You lost the screen. Am I back?
Yes, you're back.
Ah, wonderful. So I was trying to explain on the minimum capital, and I've said depending on the tier and depending on the nature, you could be unincorporated in Kenya. You can see the scenario 4, but you want to come and run either a finance or a mortgage institution in Kenya. If that is the case, you'll be expected to deposit 7.5 billion. And the reason why we are doing this, we are dealing with people's money. If you cannot show cause that you can protect people's money, and that's why it's required for any financial institution to cushion the customer's deposit by doing an impaired reserve. Yeah? And that's why we are talking of the 7.5% of all the total deposit liabilities that have been held by the bank. And this is deposited to the central bank. The reason of doing this, if you start developing some problems, like you are unable to meet your obligations, of course, central bank being the regulator, they'll be doing their on spot checks. They'll be doing their surveillance to know whether you are operating at optimum. If anything happens and they realize that there are gaps, like you recall the Imperial Bank, and we had Imperial Bank is the recent case to be put under liquidation. When they were unable, they could not even meet the obligations of paying the staff. Central Bank realized that there was a challenge. Customers could go to the bank to withdraw 100,000, but they cannot get that money because the money is not there. And the issue was corporate governance, where the management went ahead, give themselves huge loans that they couldn't pay back. There was a lot of corporate governance issues at the bank. So central bank had to chip in and put Imperial Bank under receivership. We had the case of Chase Bank. We had National Bank, but National Bank were received by KCB because it was government to government. So these are the reasons why we are asking for a minimum, or why central bank is requesting for a minimum reserve, an impaired reserve. This is money that you deposit and forget about. You cannot go for that money. It is meant to cushion the customer's deposit. Well, all the other stuff I've said, you can go and check the CAP 486. Let us go to the real thing. When you are schooling, the most lucrative or the most envied position was being an auditor. Yeah? Of course, even our lecturers could motivate us. You people do your CPAs, become certified public accountants so that you can secure an audit job. Is the best job that you can do in a bank. Reason being, even your employer, the bank doesn't have control over you. So the work of the auditor, and we know because an auditor is supposed to be giving an unqualified report. If there are gaps or if there are compliance issues, you are supposed to be reporting directly to Central Bank of Kenya. So you'll be housed in the bank that you are employed, but you don't report to that bank. So these people are pampered. These people are feared. Even the CEO and the MDs of the bank, they fear these guys because they are the only guys who can bring them down as far as issues of running the bank is concerned. Are we together? And the reason why we are studying this, the accounts for banks, you may end up finding yourself in the banking sector as an auditor. But I've said it's a lucrative job. Of course, we have the compliance and the internal audit department of the bank, and we have the external auditors. Now, the internal audit is supposed to be in charge of value addition and to be ensuring that the regulators or the regulation is followed as per the CBK guidelines and the CAP 486 of the Constitution of Kenya. The external audit is in charge of looking at the gaps. Are we there? So an internal auditor is supposed to value add. An external auditor is supposed to find gaps. So the external auditor will be working hand in hand with the compliance and the internal audit department to ensure that everything is seamless. And I say the reason of doing this, banks are the easiest loophole for doing the anti-money laundering. Right now, Central Bank has formed a department called Financial Reporting Center, FRC, and they are in charge of doing even the terrorism investigation. But because of the financial engineering, it's very hard right now to do a commercial transaction that is terrorism in nature. But we've had cases of terrorists sending money to M-Pesa agents, isn't it? Of course, an M-Pesa agent is supposed to be running a bank account. So you can see where the bank is coming in. Yeah, so the stakes are so high. So let's go to the auditor. The auditor is appointed either by the bank, but if they fail to do so, Central Bank will do the appointment without any notice to the bank. Reason being, these are the overseers, or they are the people who are supposed to be in charge of the, just looking at the, now the appointment of the auditors. Here we are. Now, subject to subsection 7, and this is the company law, auditors, there is a mechanism or there is a way that they are vetted before they are appointed. But I'm saying that if an institution, the bank or the finance institution is unable or fails to appoint an approved auditor under section 1, then Central Bank will go ahead and appoint an auditor and fix a salary. So you can see how serious it is, because the work of the auditor will be assisting in the supervisory role that Central Bank plays in the other commercial banks. Are we there? So Central Bank will require that an auditor be approved before the year. By approval means you must be vetted. Your fidelity checks, you are registered in a professional body, you are a qualified accountant and an auditor listed in Kenya by having the ISPAC number. So they'll ensure that you are approved before you join. If the institution fails to do so, Central Bank will go ahead and appoint the auditor. Now, the auditor is in charge of all the duties they are listed here. Actually, they are supposed to look at the compliance. Basically, the work of the auditor is to ensure that the guidelines of the regulator are being followed. They are supposed to report any fictitious occasion, whether criminal or otherwise. So if there are any instance of fraud or a criminal activity, the auditor can go ahead and do investigation without going ahead and requesting the CEO. Actually, they just inform the CEO. So you see, when you are doing audit, I'm not supposed to know what you are auditing, isn't it? You are an investigator. For you to give an unqualified report, I'm not supposed to know. If I'm the bank, I'm not supposed to know what you are doing. So your work is to investigate and ensure that everything is going as per the guidelines or the regulations. So any irregularity that you find, you can go ahead and report to the central bank without informing the bank. And this depends on the magnitude. There are some minor occasions where you might go ahead and inform the compliance department of the bank. But if there are major gaps, then those serious irregularities you are supposed to report to central bank. Reason being, if you don't report and central bank realizes that there was a gap in reporting, you will be held responsible. So you can imagine you went through the hard Kenyan education system, you went through all your CPAs, but the CPAs are harder than your degree for those who have not taken their CPAs. So I'll advise you to go ahead and do if you want to be a registered accountant and auditor, you need to do the professional exams with the CASNEB. So this is how things are. So the work of the auditor is to up and including checking how the books are done. Yeah. So they'll go ahead and ensure that everything is done as per the requirement of the central bank. And we've been told here that a person shall not be qualified for appointment as an auditor if they have any relationship with the owners of this bank. Either you had any business activity with them earlier, yeah, you are a relative, you intend to, you are secretary. So you can see, because you are the fiduciary officer of central bank, they'll ensure that any relationship that can make you flexi in your reporting or giving your unqualified and qualified report, they'll ensure that that gap is not there. Yeah. And if you need to change the auditors, look again, there is a precondition here. You have to notify central bank if you propose to remove the auditor. Central bank will want to know, why are you removing that auditor from your panel? Could be is because the auditor are so harsh on you and they are not allowing you to do any non-compliance issues. If it is the auditor who has decided to resign, they'll do what we call an exit interview, to up and including knowing whether there is something that they had subjected, but it was not reported in their books of accounts. So they'll have to give a report before they are relieved of their mandate as auditors, right? So the auditor's duty of confidence is here, and this is what they are supposed to do. So auditor si mtu wa kupayuka payuka. You know, you are like a CID or a criminal investigator. So no duty to which an auditor of an institution may be subject shall be regarded or contravened by reasoning of his communicating in good faith to central bank. So you can see you are not tied to be reporting to the CEO or the managing director of the bank that you are working under. Well, you can tell them for their information, but you are supposed to be reporting to the regulator, whether or not in response to a request made by it or any information or opinion of a matter to which the part applies to which is relevant to any function of the central bank under this act. And this section applies to any matter of which an auditor becomes aware in the capacity as an auditor or in the discharge of his duties under the part and which relate to the business or affairs of the institution or any associates of that institution. So you can see the position of the auditor in the bank. It is so high. The auditor is above even the MD. And the reason why we are doing this is to ensure that the books of account of this bank show the true and fair view. We don't want an instance where, and we've had cases of misreporting, where the bank adjusts the rates, they go against the KBR rates, they go ahead and report abnormal profits, but because they don't want to be noted, they go ahead and adjust their books accordingly. It is the work of the auditor to ensure that this is not happening. So without further ado, you can go ahead and see the format. This is how the bank's accounts look like. You have the statement of the comprehensive income, and what you are supposed to know as per the requirement of the CAP 486, for comparability purposes, you are supposed to compare. Now, you'll find some institution comparing even three consecutive years. For example, we are in 2020, so you'll be reporting for 2018, 2019, and 2020. Just checking. Thought it was a chart that required my attention. We go on. So I've said for purposes of comparability, we have 2 years, the previous and the current, but you can go back even to 3 years. You can do 2018, 2019, and 2020. Reason being, you already have that information. So you'll just present it here. So what is important is for the current year. So we are looking at the current year, but for comparability purposes, you are supposed to give us the previous year. So if you look keenly, we are starting with the assets. And the nature, not assets, the incomes. And the nature of the bank, the assets will come in the statement of financial position. The income, we know that the bank is in the activity of receiving or getting the customers' deposits and giving out loans. That is the mandate of the bank. We don't have any other mandate. So any income will be from the amount that it's giving out. So wewe uko kwa biashara ya kuchukua pesa ya wenyewe unaweka. Na hiyo pesa unachukua ni liability, si yako. So you take that money and you advance that money as loans. And we have different categories of loans. This is what we are calling the overdrafts. We have the certificates of deposits. You may go ahead and invest that money in the government securities like treasury bills and bonds. It is allowed. As long as that money is in a liquid investment vehicle. And by liquidity, I mean, if the customer needed that money, you just need to hit the button and get the money back for the customer. Let me tell you the reason why we had a global crisis in 2008, which started in America. In 2008, America, of course, with the culture of savings, there was a lot of, we used to call them MBS, the mortgage-backed securities. So instead of putting your money in a fixed deposit account, which was attracting very little interest, people are going for mortgage-backed securities. A mortgage-backed security, you know, mortgages are long-term investments. And it's good because you people are taking real estate, most of you. So people went ahead and took mortgage-backed securities that could last for 20, 25, 30 years, depending on the money that you needed to save. Now, when you keep this money in mortgage-backed securities, it means that the bank, the savings and loans banks, could go ahead and advance this money as mortgages to other customers who needed them. So people went for the money because they wanted to acquire houses, wakaendea pesa yao yote. In the middle of 2008, mutual funds came up with products that were earning more yield than the mortgage-backed securities. So what do you think will happen? We have mutual funds. They came up with what we call unit trust and money markets funds, where the yield was supposed to be daily. So people who had saved their money in the mortgage-backed securities went for their money to come and save in the mutual funds, the likes of unit trust and MMFs. Was that money there? The money was not there because the S&Ls, the savings and loans banks, had already advanced that money to other customers. It was very serious. The Federal Reserve of United States, of course, came and tried to bail out some of these banks, because now the Federal Reserve is an equivalent of Central Bank of Kenya in America. But the hit or the impact was felt even by third world countries. Reason being, the dollar is the most stable currency. So when the dollar fluctuated, of course, to try and correct the error, we were hit, even in all the other countries. That is how the financial crisis of 2008 was formed. It originated from the bank. So from that time, the rules were changed. There is no any commercial bank that is allowed to offer mortgages. And you can check around. Even the banks that are offering mortgages, they have to partner with a mortgager or register a separate legal entity to be offering mortgages, because we don't want to go back to the 2008 crisis. So I thought you should know this. The crisis caused one of the biggest banks in America to go down, the Lehman Brothers, if you recall. So you are allowed, however, to go ahead and invest in the government securities because we know that the government is the best customer. So that's why we are having that. Then you have the interest on the placement and bank balances. These are products of the bank, etc. So you can see all the products that are giving income, they are listed here. Yeah. So of course we know that when you advance that money, whether as an overdraft or as a loan, there is that money that you get. If of course you invest in the government securities, we expect that if there are dividends that are declared, you are going to get that income. If there are any commissions that you are supposed to draw, you are going to get that. So that's that. We have all the incomes, and these give us now the operating income. So after getting the figures for the operating incomes, we go ahead and deduct the expenses. So here are the expenses, and expenses are the costs that were involved in bringing this income. Kindly note that. So you realize that we first consider the incomes that were used, the costs that were used to bring in the income. Yeah. And then down there, we have the expenses. And these expenses are now composed of the staff cost, the salaries, the directors' emoluments as directors. So we have the directors, we have the executive and the non-executive. That's why I'm talking of as the directors, those who are non-executive. And then we have the executive. And then we have the depreciation. Then auditors, you can see the auditors' remuneration is down there. And then we have the, why do you think this entry is an expense to the bank? The deposit protection fund. I said you deposit this money with central bank and forget about it. Yeah, because the money is meant to protect the customer deposits. So it's an expense on your side. And depending on the growth, every other year, because you have to meet the 7.5% of the liabilities, if your liabilities are more, then you need to go ahead and add that money to meet the requirement. So if when you are starting, you are at tier 3 and you have now advanced to tier 2, you have to increase your deposit protection fund. Of course, and then we have the other operating expenses, name them. And then after everything, you now go ahead and do your remittances to the taxman. And then of course, you get the retained profit. Well, I'm going to have a practical example and see. What I needed to again explain is we know the bank is involved in receiving and advancing loans. We should also know that a loan is a risk. I can give you that loan and you fail to pay. The money that I gave you was not my money. The money belongs to the customer. So if that customer comes for the money and I don't have it, how will I pay that customer? That's why we are having the provision for bad and doubtful debt. And this is the fight that Njoroge had with the owners of the commercial banks when he took over as the governor of central bank. Initially, our banks used not to provide for doubtful debts. Imagine, so what they were reporting were abnormal profits. So you can imagine. So right now, what we are saying is, if I advance you credit and you are not paying, and this is how it is done. For the first 30 days, I'm supposed to issue you what we call a loan arrears notice. So you default for the first month. If you default after 60 days, this is for the second month. It means that your loan is now in deficit of 2 payments. I'm supposed to issue what we call a simple demand. Now, the language of the simple demand is not like that of loan arrears notice. Wale watu wako na tala na branch, you should be knowing this. They'll send you a text reminding you that your tala or your branch loan is due for payment. That is just a simple demand. Once it attains 90 days, This is the game changer, because two things must happen. The bank is supposed to list you or suspend this account. By suspending, it means chances of this account being paid are neither here nor there. There are higher chances that this loan will not be paid. So what they are supposed to do, once they suspend the account from their books, they are supposed to list you on what they call blacklisting with a credit reference bureau. The reason why they are doing this, they are sending an alarm to all the other players in the industry that this person is not credit worthy. So deal with him at your own peril. He's a risky guy. Once they do that, they are supposed to come in their balance sheet and do what we call provision for bad and doubtful debt. And where are they providing it from? Of course, they'll charge from their profit. So the profit that had been reported here for the year, you are supposed to deduct all the loans that were in bucket 3. I'm calling them buckets. 30 days, 1 bucket, 60 days, 2 buckets, 3 days, 3 buckets. Now, these are details of collection. If you're interested in banking, you will learn these things. But what you are supposed to know is, for any credit that has defaulted, the bank is supposed to provide for its doubtfulness. If the bad debt has been recovered, of course, it will reduce the provision because we have recovered that debt. But if it will not be recovered, it will be a loss. It will eat into the profits that were reported in that year. So our missing entry here will be the charge for the year. So we have to charge all the loans that are not performing. We call them delinquent loans. So all the delinquent loans are supposed to be charged as at the end of the period. Now, the work of the auditor, they'll be getting this report daily. There's a report when I was working in the bank used to be called U756 report. Now, this report gets all the accounts that are in delinquent. And because of financial engineering, the banking system are so intelligent. They will even place them in buckets. So you have bucket 1, bucket 2, bucket 3. The auditor is supposed to be concerned with bucket 3. Because from that bucket, they'll go to the provision to see whether the bank has provided for that doubtfulness. Reason being, we didn't get the loan at the same time. Some people came in January, others in June, others in August. So when the January loan is defaulting, the August loan is still new in this financial year. I think that is explicit. So that's the provision. You're supposed to understand that. Then, while doing the statement of the financial position, I'm just giving the nitty-gritties. I'm being granular. We have the assets, and the assets now is what the bank is holding. Unlike in the conventional accounting where we start with the non-tangible assets or the fixed assets, you can see here we are dealing with the assets first. So our asset as the bank is the cash that we are receiving, whether the cash is at the bank or whether the cash is. Now, when we talk of the cash in hand and with the CBK, CBK is the banker of all commercial banks. It means if we run in deficit of liquid, we can be bailed out by central bank. Are we there? So at some point in time, we may be having cash that belongs to central bank. This is allowed by the regulator if you go to the CAP 486 of the Banking Act. But what I needed to explain is that our fixed assets and the non-banking assets are coming below the core business. So our core business is the cash that we are receiving and advancing to the customers. And of course, on the liability side, we have the deposits from, that's why I was saying the money that you receive from the customer is a liability. In the traditional foundations of accounting, people would think that our cash is increasing and therefore is an asset. No, that money is not yours. You are holding it in trust for the customer. That's why we are calling it a liability. So whether it is in the savings or in the current account. Then we have the negotiable certificates of deposits. And these are instruments that the bank will use to use or store the money. We have the bills payable, bills that are due for collection, acceptances, endorsements, and other obligations. Of course, once you take that money to the bank, you can request the bank to be paying the salaries of your employees. So you are endorsing the bank to be performing part of your duties. Of course, they'll be charging you something small for doing that. It is not free. So if your account is held with, let's say, ABSA Bank, and you want the salaries to be paid to different customers who are scattered all over in the other commercial banks, ABSA will be initializing the EFTs, and they'll go ahead and, of course, do the necessary charging. And then from there, we'll be balancing with the share capital or the owner's equity that was held. What I want us to understand is that we normally have the notes to the accounts if there were any appropriations. I'm losing power. Let me plug in power. Yeah, so there we are. And in the adjustments, we'll see this when we come to the practical example. So the notes to the accounts, all these are normally the items that will not be affecting the books of accounts, either the statement of comprehensive income or the balance sheet. You have to notify if there are any adjustments that are not directly traceable. Just as we do when we are doing the financial reporting, you have to indicate in the notes that we have these contingent liabilities and this is how they've been appropriated. And the notes to the accounts, of course, will help in the explanation. So if it is note 1, when you come to the accounts, you'll be indicating that you have a note 1, which are bills that were received for collection. Let's go to the practical example. So the following figures are extracted from the books of Malimingi Bank. The illustrations are in the portal. So for purposes of walking together in this journey, kindly go ahead and can download, can open it. So I'm giving you some time to open the So are we there?
Yes.
Yes.
Yeah, so here is the case of Malimingi, and you've been requested by the examiner. You have the additional information down there. It's good to check out the additional information. So we've been told that there are rebates on bills discounted and purchased for an expired terms and amount. What does that mean? Rebated bills will be, well, we have to deduct this from the profits. So I'm looking at the income and the discounts. So this is the income that we are talking about. So we have the interest and the discounts. So we've been told that the rebates on bills discounted and purchased for unexpired terms amounted to 50,000. Reason being, they are accrued. It means that that discount is not yet earned. Yeah? And you know how we treat the accruals. So in other words, you are supposed to know that the discount received in advance is not yet earned. So in that case, we'll deduct it from the income and discount as a liability. Then we've been told that allow 5% depreciation on premises on original cost. Yeah, so we go to the premises. We are looking at the premises, and we've been told that they are costing 120 millions. Don't know why the examiner put these figures in two columns. They are same, so it's not like they are for two different years. But the standard is the odd year is supposed to be on this end. Then the year, the current year or the year under study is supposed to be appearing on the left-hand side. That's why we are looking at these figures. But in this case, they are the same. So I think it's an error. It's an error. So we've been told that we allow 5% depreciation on premises on original cost. So you can see at cost they are on 120, but there is information again hidden here. Premises after depreciation to 1st September 2014 of 10 millions. So this is not original. This is after deducting the 2014 depreciation, which is 10 million. So our original is supposed to be 130 million. So you'll be getting 5% of the original cost, not on the on cost, on the original cost. Reason being, we don't want any figures to be hidden. Remember, we are doing this as auditors to ensure that there is not any misrepresentation of the true and fair view of the account. Then we got a provision of doubtful debt of 300,000 required, and then a provision for taxation of 1 million. So this is the legal aspect. So we don't have further additional information. So we are required to prepare the statement of comprehensive income for the year that is ending on 31st August 2015. Yeah. So we first need to adjust. I've said we need to adjust the income and because we've seen that there were rebated bills that were discounted, and these are accruals. We need to, now for internal management, or if you recall the management accounts, we need to know the true and fair view by deducting these rebated bills from the interest, income, and discounts. And this will help us know now the net interest and income. Of course, we've seen there are accruals also. You can see, I see accrued interest. Yeah, we have interest that is accrued. So for fair and true view, we need to get the net interest income. And it is from here that we are going to deduct our operating expenses. So let us do that to know the profit before tax. So allow me to stop sharing this screen and start sharing an Excel sheet. So for those people who are willing to work as auditors in the bank, this is your thing, but it's interesting. I've done it, so it's interesting. You can easily develop a kipara. So if you need to have receding hairline, these transactions are so many. So let me stop sharing and start sharing the Excel. And I've said we need to get the statement for internal management. Let me just call it the statement of comprehensive income. Comprehensive income for the year is ending 31st August 2015. And I've said this is the internal management. So just call it for internal management. So this will not go public. So what will go public is the final statement. Can have two columns. Let us put our amount in millions, in thousands. So we go. I've said we start with the income. And in the income, we have the interest income and discount. Just go back and copy paste instead of doing all this manner of, we have interest. How is it? What's the figure? What is the figure?
11,500.
11,500. We have adjusted that. There are accruals in that amount. This amount has accruals. I need the interest income and discount. Can just put it here. We have 11,500. We less the 50. Yeah, the accruals. You'll call the rebated bills that were accrued. So this will be 11,450. Right? Then from there we have the interest accrued and paid. And just copy paste. So interest accrued and paid, the year 2000. The year 2000, but we are deducting because the year accruals. Yeah? What else do we have? If you go to the question, you'll see we have the net interest income for that particular year. And the net interest income is 9,450. Can you see it? Yeah, the people who are on the question. So we'll add that back to get the figure for the net, to get the figure for the net interest income. Wait a minute. So this will be less, we just add. We go ahead, give me the expenses. We did the expenses. And the expenses are the ones that are operational in nature, because this is for the management. We'll be adjusting the overall statement of comprehensive interest. So I'll need the operating only, the operating expenses. Give me the operating expenses. You have the salaries. Guys, are we in the equation? What are the salaries? The figure for salaries? 800. Go with me, please. Then yeah, we have rent.
200.
Rent is 200. Then we have general expenses.
100.
100. Then we have which other operating expense do we have? We are depreciating our premises, isn't it? So we have depreciation. What will be the depreciation? We've been told to take the 5% of the original cost. So what is 5% of 130 million? You are getting?
6,500.
6,500.
6,500.
Yeah, correct. Do we have any other operating expense? We need to less the provision for bad debts, but that is not an operational expense. We are supposed to do that after getting the operating profit. So that's all. Cannot see any. So this gives me a total of 76. So I should subtract 76. Now it should be this minus this. So I'm getting 1850. So this will be my operating profit. I have a challenge with my keyboard, with my O. So from here, we can now net off the provision for doubtful debt, the provisions for bad debts. And we've been told that the provision for bad debts is, let me check that, it is 300, right?
Yes.
So this will give us now the profit. But this profit is before tax. So profit before tax, or EBIT. So my profit before tax is 1550. Yeah.
Yes.
So that is our, of course, this figure will be reported. The management need to know the current position or the profit before we apportion anything else, right? So if you look at these figures, we have not deducted the non-operating expenses. These like the director's fees, we have the auditor's fees, we have not. The taxation, we have not, because they are non-operation, right? So in compliance with, we know that in compliance with the CAP 486, the company law, they are supposed to be disclosed. Can you hear me? I'm saying in compliance with CAP 486, you are supposed to do a full disclosure. Full disclosure is to show the operating and the non-operating. So you need to adjust this figure, but this is for purposes of complying with the Companies Act. So can we adjust it?
Excuse me, sir.
Yes.
The amount is 1550, not 1150.
It's 1550.
Yeah.
1550. Yeah, thank you for that correction. So I've said the first part, this is for management purposes. Now, in compliance with the capital, with the Companies Act, CAP 486, we are supposed now to deduct the non-operating to get the profit after tax. So you can go ahead. So I'll just be a continuation of this one, or I can just indicate here in compliance with CAP 486. We need now to do the adjustment. So I'll take this figure. So you go ahead and deduct now the non-operating expenses. Yeah. And we are doing this after we charge them. You see, we have to pay before we transfer the figure to the income statement. So what is the director's fee? Director's fee?
50.
50. Then we have the auditor's fee.
20.
20. Then we need to charge depreciation is also not an item of operating for this case. In compliance with CAP 486, you are supposed to deduct it, isn't it? So you have depreciation. The figure for depreciation is given here. T65. Then you've been given the taxation. What is the figure for taxation? Our taxation is 1 million.
Yes.
So what do we get? Yes?
7570.
7570.
Yeah.
We are just doing a disclosure.
we add all that 50, 20, 65 plus that 1,000.
Are we supposed to add? We are doing disclosure in compliance. Now we've been given the figures. We are not supposed to go to the question. We've been given what is our profit and loss that was brought forward. What we need is profit after tax. We are just doing the disclosure. So our profit after tax, maybe to avoid confusion, if I take this here, we are supposed to indicate the profit after tax. Our profit after tax will be this amount, isn't it? You see, the figures that we are looking for, we have the profit. Let us work backward. We have the profit that was brought forward. So you have profit and loss. What was the profit and loss that was brought forward?
6,600.
6,600.
6,600. Then we have the profit after tax. What is our profit after tax? Now this was the brought forward, sorry. I need a carried forward, and this is what will go to the, let me push this a bit. This is what is going to our profit and loss carried forward. This is what is going now to our statement. Yeah, this is the figure that we are looking for. So once we deduct this figure is supposed to be a minus, and subtract this, let me put it in the bracket. So this will give us 550. So the figure that I'll be taking will be the figure, this plus this. That will be my profit and loss that will be carried forward. Is it understandable now? So I'll be taking 150. This is the figure that I'll be taking to the statement and put this column in. This is the figure that we'll be taking to our statement of comprehensive income. So we are doing, or we are disclosing, as per the CAP 486, you are supposed to do permanent disclosure of the amounts that you are paying to directors and the amount that you are paying to auditors, and also any depreciation. And the reason for these three items, 20, 21, and 22, we know that this is where money is hidden by the banks when they are doing a misreporting. Tuko pamoja?
Yeah.
So can we go ahead and do the statement of comprehensive income?
Yes.
You have the format. So now this becomes very easy. So you start with the assets. I can do it here on the side. Who is speaking French in my class? Mute yourself, please. Control copy. Huyo amejua mahali ya kuguza. So we can go ahead now and list them. Let me pick this, copy. So you start with the assets. You have the format, guys. We go. And we said we start with the assets that are bringing in income. So can we start? You have cash in the bank. They are the people who are supposed to be supplying this. What is the cash at the bank? 600,000.
Yes.
Then we have cash with central bank. What's the amount?
15,000.
Sorry. Then we have
15,000.
cash with other banks.
13,000.
You know, when you're in the business of transacting this cash, you may end up depleting your cash, and there are customers that still need money before you close. Yeah, we know central bank closes down at 3. There are some other banks that closes at 4, others at 5. So it is allowed in the business of banking. You can borrow from your next bank, and of course return with something small. So this is what we are calling cash with other banks. Then we have money at call. What's the money at call? What's the call? What is the total? Now, money at call, this is money that can be given on short notice, right? Maybe someone had invested in some mutual funds and they need to recall the funds. This is what we are calling the money at call and at short notice. 3,000? Then we have investment at cost.
30,000.
30,000. We have loans, ODs. When I say OD, these are overdrafts, ODs, and cash credits.
70,000.
70,000. Allow me to put this in money form. What else? Do we have the provision for bad debt? Because you are supposed to deduct it from the overdraft, from the loans. This is an actual figure, there's 70,000. We are supposed to less, if you look at the format, we are supposed to less the provisions, isn't it? So what's the provision for bad debts? It is indicated there. Provision for
300,000.
300,000. So this is supposed to be subtracted. So our figure will be 69,700. Yeah?
Yes.
We go on. Trying to look at my question. What else do we have? Are they over?
What about the bills for collection? Are they
Yeah, we have bills, even the bills discounted and purchased. Yeah, they were discounted and purchased. So it's an income, isn't it? So bills discounted and purchased.
60,000.
60,000. Then we have the bills for collection, they are due.
It is 6,000, not 60.
Yes?
6,000.
Oh, it is 6,000. Thank you.
6,000, not 60.
It is 6,000.
6,000. Mm.
Okay. Bills for collection,
1,400.
1,400. What else? We have also acceptances. We have acceptances and endorsements. They are for 2,000.
No, 2,000.
Have we left anything else? Borrowing from other banks, that's a liability.
There is additional information on that, Nini.
There is?
Unexpired.
Jackie, we cannot hear you.
On that bills.
Jackie, you have a problem with your network. Jackie, can you hear Jackie?
Additional information one.
About the rebate bill.
Additional information one.
I'm there. I'm there.
Yes.
Rebate on discounted and purchase for unexpired terms of
I'm saying
50,000.
there's an additional information one.
Yes, I'm saying that one, we adjusted it. We adjusted it in the internal management books. So if we do it again, we'll be cascading. We'll be doing double. Got me? We adjusted it. We already adjusted it.
Sir.
Yes. So I cannot see any other, So we go to the premises. We can now go to the assets. The on cost of the premises, we say is 130 million. We deduct the accumulated depreciation. What is the accumulated depreciation? It had depreciated for 10 million. Then we added the depreciation for this particular year. It was 6.5.
Yes.
So our total will be 16.5. This figure should be in bracket. So we are getting 113,500. So our total assets will be, escape. So our total assets will be I don't know why I keep getting this thing. So our total asset is 324,200. We go to liabilities. Give me the figures for liabilities. I can see borrowings from other banks.
$7,000.
7,000. Just put it in this column. We go on. I have the fixed deposits accounts. We say this money belongs to the customer. It's not the bank's money. So fixed deposits. What's the amount? 95. Sorry for that. We go on. Savings banks. Nyinyi mume- So we go on savings bank deposit. Sorry for that. What's the amount?
That
30.
30,000.
We go on. What else? I have the current accounts. They belong to the customers.
80,000.
80,000.
Then I have bills payable. What's the amount?
8,000.
8,000.
Then I have bills for collection.
Do you not
100.
put them
400.
under the assets?
Yes.
Do you not
It's not
put them under the assets? No,
Bills
no.
for collection. We listed them
1,000.
as assets.
Yes.
Yes, we have to put them as assets.
So we're supposed to deduct. What are bills for collection? Let us ask ourselves that. What are they? Are they payable or receivable?
Receivable.
If they are receivable, then they are supposed to be up there. We need to know whether they are receivable or payable because we have two categories. If they are receivable and they are for collection, they'll be assets. Well, the equation is not very clear, so can delete them down there, up there, and put them up here. But you have bills payable.
For me, I thought
Anyhow.
the bills for collection
Mhm.
was like rent where the bank has like they have good rentals and
We'll assume that they are receivable because we've been given any payables.
We've been given payable, so we assume they are receivable, isn't it?
Yeah.
Yes.
So I forget about them.
unclaimed dividends.
We have the unclaimed dividends. What about the acceptances? What about the acceptances and
We deduct.
on behalf of customers? Yeah, on behalf of the customers. That I want you now to think as a bank. Acceptance and the endorsements on behalf of customers.
Yes, it's like services.
So where should we place them?
We should subtract them from the liability side.
So they are liabilities, isn't it? Are they liabilities or they are assets?
Liabilities.
They are liability.
It's liability.
Yeah, we are receiving
Yes.
them on behalf of customers.
Yeah.
You have to think like the bank, not like the customer. So where are they? I had added them.
Up there. Yeah.
Which cell? Oh, they are here. I can just cut. So this has reduced my figure to, this will be 322. We confirm.
322, 200. So there is 200.
They are?
322, 200.
Where is the 200 coming from?
It was supposed to be 324, 200.
Or 324, 200?
Yes.
Sir,
Excuse me, sir.
Yes? You excuse?
We add 1,000.
We
added 70,000 in loans, and still we had added 69,700 after deducting the budgets.
This is supposed to be off, huh?
Yeah.
Because you have already, yeah, good. So what do we get? Yes?
What about the bills for collection?
Bills for
I
collection.
don't think that we can assume that, yes. I don't think that we can assume that to be receivables. They're direct, as in they are clear bills for collection. So I think they should be liabilities.
They are liabilities.
Yes,
they
they
have
are
a
direct.
question on that.
They are saying that it's bills for collection.
I
Yeah,
have a
So
question on that.
you have a
the
question.
issue of assuming
Yeah,
Uh-huh.
between the customer and the bank, who is the collecting the bills?
That's the question that I had asked. Whether it is
Me,
for
I think it's the
customers or
bank.
for the bank.
The bank is the one for me, I think the bank is the one collecting the bills. So they'll be like receivable.
They'll be
So
receivable.
everyone.
I had
bills
put
for
them as
The
receivable.
bank.
Yes.
But the bank has already collected the money.
I ask, you see, bills receivable, they can be both sides. They can be either from customers or they can be from the bank, isn't it?
Yes.
But for this case, because you've not been told, what are we supposed to assume? It's the bank that is preparing the yearbooks, isn't it?
Yes.
So it is supposed to be a receivable.
Yeah.
Yes.
That's why we had retained them there. That's okay.
Yes.
No, we'll argue, we'll still argue because our books will not balance with all these contentious issues. I can already see. We'll still come back to those figures and see. Yeah? So we go on.
And creditors.
I wanted to go optimistic to Madrid.
Yeah, we go on.
And like creditors.
Yes? Yeah,
And like
we have unclaimed dividends. I'm trying to look at the figure for 300.
300.
Uh-huh. $200, 300.
Yeah.
300.
Uh-huh. What
about
else?
the reserved fund?
Reserved fund. Reserved funds is capital in nature, my friend.
Okay.
We have the sundry creditors.
Sundry
isn't it?
creditors.
Uh-huh. Sundry creditors.
300.
300. Uh-huh. Look at the additional information. We are providing for taxation, isn't it?
Yes.
The 1,000, it will be a liability to the bank, isn't it?
Yeah.
What about the rebates? Let me call it provision for taxation, because taxation is not an item of, so this will be 1 million. What about the bills rebated? They are accruals, isn't it? Accruals are liabilities.
50.
What's the cost? Rebate on bills
50,000.
discounted, they were 50.
50,000.
50,000. So did you add this? What did you get after the contentious issues? What did you get? $252,200. 200. We have the liabilities. They are 138, 150. So subtract that from 252, 200. What do you get? And the balance in figure. 252, 200. What do you get? Guys, 252, 200 minus 138, 150.
1,050.
You are getting?
114,050.
114,050.
Yes.
We go now to the capital side. So financed by, you have the share capital. What was the share capital? I have to go back to the question. Share capital was 50 million.
Yeah. Yes.
50 million. Then you have the reserve fund. Who was asking about the reserve fund? 35.
Yeah.
Then we have the profit that was brought forward, the retained profit. It is 61,150. So we are getting a total of 114,650. Why is the 600? So there we are. Where is the 600? Guys, we are in it together. Where is the 600? Our books cannot balance.
I think I found the 600. The profit that we got, it could have been, it was 60,050, not 61,150.
It was 60?
60,050.
60,050, this one?
Yes.
It is 60?
050.
Where are you getting that from?
It's 61, 150.
We are adding that 60, 600 with the 550.
61, 150.
It is 61, 150.
It's okay. That one is okay.
So you see, as the auditor, this is where now things become elephant. This is where you start answering questions to central bank on why your credit side is more than the debit side. No, the argument is you are stealing from customers. Yeah, you'd rather have a deficit than a surplus. A surplus means if you cannot account for that money, customer anakuja kuweka 10,000, wewe unaweka 80,000 kwa account. Now, as we ponder this, can we try to do the other practical example to see whether it will balance? So I've given that as an assignment. There's an assignment that I've posted in the portal. I'm told you people are supposed to sit for your exams from date 8. Are you aware? Has it been communicated?
It was date 14.
It's date 14. I've seen
Yeah.
a memo indicating 8 to 14.
It is 14 to 18.
Or it is 14 to 18.
Yeah.
Yeah, but
so
for diploma parts, diploma.
Diploma, the ones who are starting on 8.
Yeah.
Yes.
We are
It's
starting
okay. It's okay.
14th.
Then we have some other 2 weeks. So can we try to do the practicals? I'll save this. Let me save this. I will look at it at my, let me save it. Mali mingi. So we can end the class at that point. You can try to practice with the questions that I had shared in the portal. Then we'll carry on from there. So I want to end it at this point. Enjoy your day.
You too.
You too.
You